All right, team. I am back. He's back. Oh, I'm not used to the buttons yet. No, sincerely, had no idea that I would leave town for a week and have so many people going, "Hey, where's the video? Where's the video?" Of course, didn't help that it was a crazy action-packed week with lots of things going on, including a crypto crash. Going to go through a little bit of everything today, set the stage for what's next. And just, we're going to be super pragmatic here. I'm not going to be one of those people. I've been through two of these sort of weird scenarios. I'm not going to say crashes, but I've been through two really significant. If you look at, I don't really consider .com or Y2K to be a big thing, but 2001 definitely was. 9/11 definitely was. And 2008 definitely was. And I remember both of those very clearly. Was in the business. Emotions. I watched emotions get the better of people. And I've seen it happen a lot since. And I've gotten myself to a point where I'm not going to be one of those people. I'm just simply not going to be like, the sky's falling. It's all going to zero. Get out. Run, run. No one makes any money doing that. No one gives good advice doing that. So I'm going to stay chill. We're going to look at the information. We're going to make decisions about what's next based on that. Now, some of the stuff I'm going to show you here is going to look bad. Some of the stuff I'm going to show you here is going to look pretty good. We're going to assess all of it. Who's it good for? Who's it bad for? We're going to go through all that. Okay. Derrick Evans here. VA, home loan specialist. If you need a VA home loan, shoot me a call, text, email. Love to help you get a quote and help you buy a home or refi. Buy or refi, give me a shout. Okay. I'm a little rusty, as you can tell. Let's get me out of here. So we'll start off here with this one. This is a surprisingly bullish-ish article from CNBC and Diana Olick, who has been super bearish on real estate as long as I can remember. I mean, 2016, 2017, 2018, they just kept talking about how bad housing was overbought. And they were so wrong. And that's the only thing that scares me about this article is oh my gosh, these people have been so wrong. And here they say something that actually makes sense. Now, the only reason I bring this one up isn't because of the headline. It's because it actually delivers. This is true, legitimate journalism here. I'll call it what it is. Listen. If it's there, I'll tell you. And the reason why is because this is just chock full of data, very similar to the video that I made, but just totally different data sets. Talking about average credit scores. The average FICO score right now is 751. Shortly after the crash, it was 699 in 2010. The number of ARMs, the percentage of loans that have ARMs was 30-some% back then. Now it's only a couple percent. There's a whole bunch of different data points in here I want you to check out on this, but it's very, very true. This housing cycle that we are in right at this moment is very, very different from the previous crash. Now, that doesn't mean that it can't crash. That doesn't mean that it can't get sour. That doesn't mean that it's bulletproof, but it's very, very different. And if you understand how this stuff works, you'll know that last time was a worst case scenario. Pretty much no way it can be that bad again. I mean, I don't see how it could. You're literally making up mortgages. They were making up mortgages out of nothing and treating them like they were AAA paper. I don't know how it could get worse than that. And then everyone found out at the same time, oh shit, that's what's going on?
Check, please.
Hey, get the hell out of here. So we are nowhere near that, nor could we be, in my opinion. Here's another one I threw in here. Recession fears are really, the fear is the thing that causes most of the problems, because recessions and pullbacks are just normal parts of a regular moving economy and a regular moving process of just capital markets. But the fear is what causes people to do things that are irrational. Fear of missing out when people were paying way too much for homes, going above list price, going above appraisal by 100, 200,000. We know this happened not that long ago. That's fear of missing out. Fear of being in when you shouldn't be is the typical fear that we see, and that causes markets to capitulate. I'm going to show you a couple different things on that today. All right, so let's first go and take a look here. If we want to get acquainted with where the market is, we're going to use our Altos research here. Let's see if I can zoom this in a little bit better for you. That just takes it all out. We do it that way. Do we get the data? Oh, you know what? Let's do it that way. So we now have the market action index for detached homes in San Diego is at 79. That's the lowest I've seen it. It dropped from 88 the previous month and was in the 90s before that. So you can see the pendulum is swinging towards the buyer side. Who is this good for? Who is this bad for? This is bad if you're someone who is about to put your home on the market. If you are a seller in this market, this is bad for you. So what does that mean if you're on the other side of the transaction? If you're a buyer, that means this is good for you. Okay, let's keep that in mind. Who is it good for? Who is it bad for? That's going to be the theme for today. We're going to look at all these different things that are sort of impacting aspects of the market. Who's it good for? Who is it bad for? Pretty much, we look at this market action index dropping down to into the 70s, which is still a seller's market, right? But we've seen this thing almost at 100. It has peeled back quite a bit. Buyer's market doesn't happen until we're at 30. We've got a ways to go, but it's headed in that direction, and it's headed there pretty fast. It's headed there pretty fast for a number of different reasons. Okay, let's take a look at these stats here. So median list price pretty much staying flat. Listing, same thing. Price per square foot is dropping now. 710 was our high, okay, and that was back in mid-May, and that's now dropped down to 685. We're going to take a closer look at that here in a second. What's going on with that? Average days on market, still pretty low. 26. This has remained pretty flat. It's increased a little bit. I mean, we saw 19 here in the past few months, up to 26. Still not taking very long to sell homes. Not taking very long to sell homes. However, look at the price decreases. In the beginning of March, we were under 10%, and now we're at 34% of homes with price decreases. Is this a bad thing? No, this is sellers figuring out what's going on. They're figuring out what's happening in the market. That's one of the ways the sellers figured out, because most sellers aren't savvy enough, and frankly, most realtors will have a hard time getting sellers to do exactly what's right because the sellers just aren't savvy enough to list the price aggressively, let the market frenzy. If you're a seller, listen to your realtor. Just listen to them on this, because you're leaving money on the table with these price reductions. But this is just finding the market, okay? One of the things that sucks about selling your home is that you have to go first. If you're in a negotiation, you never want to go first. Ever, right? If you go to your employer and say, I think I deserve a raise, they say, well, how much? You say, I don't know. How much do you think? No one wants to go first. No one wants to go first because you don't know where you're at. Well, when you sell your home, you have to go first. And so that's all. Immediately, it's a bad position to be in unless you use it for a benefit by making it a very attractive lower number. Sellers just have such a hard time doing it. Not much on the price increase side. Relisteds have gone up a little bit, just about 5% since the beginning of March. Not bad, from 10% to 15%. But look at this inventory graph, slowly increasing. We're going to take a close look at that too. So we're going to look at inventory. And we're going to look at price per square foot here in a second. Median rent continues to climb. $3,900. We talked about the market action index that's been declining. So all these things are just kind of, that's what we expected. Okay, so let's look at price per square foot first. Now, I want to look at a couple of things on this graph because, just get you that. So the 7-day average is the one that's moving more. The steady, more thick red line there, that's the 90-day average price per square foot. Now, if you look here where we are right now, the 7-day average is below the 90-day average. The 90-day average is $698 per square foot. This is detached homes in San Diego. 7-day average is $685. It's very rare that we see that happen, although we're going to look at this, and this is going to tell us quite a bit. This is one of the nuggets today. So listen up to this one. So we see this has happened. It's middle of June, and the average price per square foot has dipped below the 90-day. Still looking really good. Overall, the structure of this move is very, very good. When was the last time we dipped right below? Well, I'll be darned. How about that? Early June of 2021. When was the last time we did it before that? Let's see. Where is this here? Look at this. Middle of June 2020. There is seasonality here. This is what I was talking about before I went out of town, is that this time of year, it seems to be a lot of vacations. People are just, kids are out of school. It's really hard to figure out what to do with them and shop for a home. It's tough. This is just a tough time of year. Every year it seems to be like this. And the numbers here show us when we get these dips. Now look at those dips. Those are the previous dips. Now, who knows what will happen moving forward? Doesn't mean that this will continue. But each June, when this has happened, has been the best entry point for a buyer that we get on this graph, other than just buying 20 years ago, right? But if you look at it, if you're trying to time this, hey, what month of the year should I buy to get the best price per square foot? June, which really means you need to be in contract in May or very early June in order to get it. Because what happens each time from there is that we move higher. Now, that could be different this time. There seems to be more going on in the market this time than just that, right? We have interest rates, which we're going to take a look at here in just a second. So let's look at homes. All right. So those are the two. Oh, wait, here we want to look at inventory. Inventory. There's inventory. You see it's creeping up. It is. Again, the 90-day average is this thick red line. The 7-day average is the spotty red line. And you can see we are definitely in an uptick on inventory, but we're still not where we were even just 2 years ago. We're not quite at those levels yet. We're really close. If you go back 3 years, we were much higher in inventory. So inventory is still low, but here's what you're going to see. And this is one of the metrics I like to, this is like one of my favorite things to do, is to just take a look at how many homes for sale. I like to do, in this case, I'm going up to 800,000. I'm on Redfin here, detached home, 3-bed, 2-bath. That's it. Those are my only filters. What I like to look at here is I like to look at quantity. Okay, let's look at quantity. It's only 285 homes. That's not that much. It's not that much. I know it's more. I know that. I get it. But that's not that much. I've seen that number way higher than that during the bull market. But what is interesting, though, is that I only see 2 hot homes. And I can't figure out either one of them for the life of me, why it's a hot home. If you look here, we got this one for 690. It's in the 92139. It looks like it's pretty nicely done, but it's 92139, detached house, 1,000 square feet, and it's 690. I mean, and it's a hot home. So have prices really dropped that much? I mean, I don't know. I know prices are softening, but that one's hot at 690, and the 92139 is 1,000 square foot home. It doesn't have a pool. It's nicely done. But I mean, you tell me, that's a hot home. Okay, and then the other one on here that I see that's a hot home is this one. It's on Skyline in Lemon Grove, 91945, Lemon Grove. It's a $790,000 home, and this one does have a pool. Yeah, this one has a pool. Not a huge lot, but enough for a pool. So you got a pool home in Lemon Grove for $790 is hot. And then you have a non-pool, nicely redone home in 92139 for $690. Those are our 2 hot homes. So, couple things here. There's only 2 things we can assume from this. Let's see, you probably can't see this very well, can you? I don't know if there's really a way for me to zoom it in without not being able to see the whole thing. 2 things that could be happening here. Number 1, there's a lot less buyers. Number 2, we just haven't seen prices come in enough to entice the buyers. And it could be a combination of the 2, but my guess is that as of right now, at this moment, we just haven't seen prices come in enough to entice the buyers, because there's buyers out there. There's definitely buyers out there. They're watching. They just haven't seen the prices get to where they're ready to go gangbusters for it yet. And so I think we have a lot of buyers waiting in the wings. We have a very, very strong and big bench of buyers. Let me tell you, there's a lot of people who decided to rent from the beginning of the year until now. Those people in 12 months, they will all be looking at the market again. It's just going to be interesting to see where that market is when they get on the other side of their lease and whether they will then be enticed by that or not. If you'd think, well, if the market goes down 10%, that won't make them want to buy. But people do everything the wrong way. They do everything exactly wrong. If it's gone down 10%, then they'll say, well, let's rent again. Maybe we'll go down 10% again. You know what I mean? It's very difficult for people to time these kind of decisions, which is why I don't recommend it. I don't recommend trying to time anything. It's so hard to do. But that said, this is where we're at. So we see the market action index just sort of plummeting all the way down to 79. That's the lowest that I've seen it, and since I've been tracking this. So we knew the pendulum would swing the other way. Starting to see what that looks like. Okay, now let's look at interest rates. Interest rates have definitely spiked. It's definitely from the beginning of the year we've seen interest rates go from 3.11, and now we're at 5.78. So we've got a 2.6% increase in the average interest rate. That's definitely starting to take a toll on the marketplace. And these are the things that we've been talking about the entire time. I have two concerns about the market. Number one is if interest rates go too high too quickly. If that happens, it can cause real problems with the sentiment. It causes people to go, hell with that. Remember, every buyer wants a deal. Now, everything we've been talking about so far today, it's all bad for sellers. Like the competition here, that's bad for sellers. It's good for buyers. But buyers won't be interested when it's really good for buyers. Because when it's really good for buyers, it's actually when it seems very disinteresting for buyers. When the market's going crazy and raging and people are paying above and waving this and that, that's when it seems like it's the right time to buy because everybody's doing it. The best time to buy, though, is when people aren't, when you have some negotiating power. And most people won't see that. So this is where you have to guide people, guide your friends, guide your family, guide your clients if you're in the industry. That's actually the time to buy. Now, is this the bottom or is this the beginning? There is definitely more time to go before this gets flushed out. The question is just how much will the market be affected? How high will these rates go? You know what my prediction was? I made that loud and clear, 6.5%. So if I'm right, we've got another 0.75% to go. And that ain't going to help things much. That's for sure. It may not hurt them a lot, but it ain't going to help things much. Right now, looking at interest rates, looking at mortgage bonds here. Let's zoom out a little bit more. That's pretty ugly. That looks like the backside of Everest. That is not something you want to invest in right there. That is a terrible looking chart. Horrible looking chart. And I believe that this trend line, or something similar, yeah, look at that. That is the one that has held. So no bueno. Not good. But we saw a bounce here. This is a 4.5% coupon. We saw a bounce here. We've made some sort of structure here. I don't know what you would call this. We've made a structure, and it's got some nice wicks on it. So there's buyers in there. Okay, there's buyers in there at these levels. This is good, but we've got a lot of resistance overhead. This level right here will be Herculean to get through. I'm just hoping we can get up here to 100, somehow get in here and start making noise back and forth in this range, create a new range. That's what I'm really hoping we'll see. I don't know if that's possible or not. I don't know if there's going to be enough oomph, but if you look at the RSI, it's going the right direction. It's still at a very low level. There could be more left in the tank here for rates to drop a little bit in the interim. But we can see the direction they're headed. Bonds are headed lower, rates are headed higher. That's going to happen. So with higher rates and with more inventory, buyers have more selection opportunities. It's becoming more of a buyer's market. This isn't great for sellers. It's not good for sellers. It's good for buyers. Finally, buyers get some good news. What I'm going to be really watching and what I'm the most intrigued by is what's going on with institutions. So let me just share with you a story here. Let me show you something. So I've been getting calls. I know other people have because they reach out to me and say, hey, are you getting these calls? I'm like, yeah. There are funds that are doing huge money raises right now. And the call to action is to buy real estate when the crash happens, essentially. I think I did an article on this that came out where they were talking about these funds that are waiting in the wings for real estate prices to drop and for there to be massive carnage. They come in and swoop up the properties. I've been getting the calls to invest in these funds. I'm not going to because it's probably not going to even happen. Other people I know have been getting these calls as well to invest in these funds. And so if you look at, well, what's the gotcha? Where is the thing that we don't see? Where's the thing that's like the mortgage bond, ratings agency fraud that took place in 2008? Is there something like that in this particular market? Is there something that we need to really be worried about that could cause problems?
Hated it.
It's institutional ownership. Institutions have been buying tons and tons of real estate. If those funds get margin calls, if those funds get redemption letters, meaning that investors say, I want to take my money out, I don't want to be in here anymore. If they aren't set up with the right capital structure, then they may have to sell homes as a result. That could cause a cascading effect. That's probably the biggest danger to the market. But I am directly and keenly aware of not just the people who've called me, but other people whom I know who work in or on Wall Street, that there are tons of funds waiting to buy real estate. Tons. In fact, BlackRock has been continuing to accumulate real estate at a significant level right here through one of their subsidiaries. So if it is Wall Street who stubs their toe here and gets those redemptions and and they're forced sold to sell these homes, there are definitely buyers waiting in the wings, whether they're residential primary occupant buyers or whether they are institutional buyers. That I don't know, but it's going to be most likely institutional buyers. If the market really does crash, that's what they've been waiting for. They're set up for it. They're raising money for it. That's what's happening. So I want to make sure you're aware of that. Just the fact that that is going on in huge quantities, insane quantities. It is a real backstop for the real estate market. I cannot say the same for the other markets out there. I cannot say the same. Here's something that's very, very interesting. Before we talk about stocks, I want to just show you something. This is really, really interesting. Okay. ProShares is launching a short Bitcoin ETF this week. Now, get this. The SEC has not approved a Bitcoin spot ETF, meaning that you can long Bitcoin or you can own Bitcoin through an ETF, but you can short or bet against Bitcoin with an ETF starting tomorrow. Okay. Bitcoin has been the single best ROI asset for the past decade, but the SEC doesn't want you to own it, but they'll let you short it. What can we surmise from this? There's so much going on with this. Number one, they want you to be poor, obviously. Number two, they don't care about it being fair. Number three, they clearly don't like Bitcoin and they really don't want it to work. And number four, this is the big one. There's no doubt about the fact that institutions are looking for weak money to come in and sell Bitcoin to strong hands, aka institutions. The reason they're offering you the short ETF after the market is already down, how much? How much is Bitcoin down now? I can't even remember. Let's take a look. I think it's like 70%. Whoa. Right at this moment, it's down 70%. Total was like 75. Right now, it's 70% down from the high, and the SEC wants to give you the chance to short it now. So what's going to happen is a bunch of weak, dumbass money is going to come in. Maybe it'll even work. Look, I don't think there's nothing that looks good about the Bitcoin chart. There's nothing that looks good about any of the stock charts. We'll look at them in a second. They all look terrible. They all look like there's a lot more pain coming. Doesn't mean there is, but that's what it looks like. And so it may work for a little bit. But at the end of the day, what they're doing here is they're raising weak money to get on the short side of the Bitcoin trade because I believe that institutions want to come in and they want that liquidity. They want somebody to come in, some sucker to come in and sell them Bitcoins at 20,000, 18,000, 15,000, whatever. That's what appears to be happening here. Don't fall for this. Don't fall for this. Maybe it'll work. Maybe it'll work. Now, I'm glad that they're going to have a short Bitcoin ETF because it makes it a lot easier for me to hedge my risk. Right now, I'm short the NASDAQ because I didn't have a way to really short Bitcoin unless you get on some weird exchange in a different country, do all this crazy stuff. This will make it much easier for me to hedge my position in Bitcoin by just buying calls on this short ETF. The same way I buy puts on the NASDAQ. But it'll be much more directly correlated. So it's a good thing to have, but it makes no sense at all, none, for us to have this and not have a long Bitcoin ETF. It's just the elites, the very rich people and powerful people in high government and rich people on Wall Street just laughing at us. Let's give them a short ETF. We don't let them buy it. Don't give them a long one. What are you, crazy?
Yeah.
But let them short it. Let them short it right into my wallet. So be careful. Be careful with that one, okay? All right, that's Bitcoin. Looks terrible. We're in an awful downtrend. It's a terrible looking chart. Everything sucks. I have no good news for you here. And really the same, S&P, there's a gap to fill there. I don't know. It's coming off of that, but it's just also a very ugly downtrend at the moment. NASDAQ, similar. Dow is the one that looks the best, but it also doesn't look great. So we're about to find out this week how things look. Now, the Fed raised rates 0.75% last week, and we saw, let's see, that was a Friday. So on that day, it was a very volatile day, but we ended up, much higher. We actually created a range high on that day. And so there was a lot of buying in the bond space, which is really good. We need, buyers in the bond space. But the Fed really still hasn't done a whole lot. And we're really not going to recover from this until we get on the other side of inflation. We're not going to get on the other side of inflation 25 basis points at a time. I'm glad that they've increased it. Think about this. The Fed said it was transitory, and then a year later they went 25, 50, and then 75. Is the next one a full point? Or another 75? They've made it clear. The Fed has made it very clear. They want to attack inflation. Inflation is their main concern, and it should be. They're not worried about anything else, though. I think they will let everything else burn if they have to rein in inflation. And I think that it probably is the right thing to do. It's just a shame that they're so far behind. I mean, just reading their notes, the economy seems to be okay, and this and that. Gosh, you guys you're living in 6 months ago. That's where they live. The Fed lives in 6 months ago lane. And so their actions just aren't relevant for today. It seems like they're always behind. Now they're trying to catch up. 25, 50, 75 bips. So we have to just sit here and hope that they ultimately figure it out. But I will say it's nice to see the acceleration, and it's nice to see that there's a commitment there, but we're going to need a little more action, a little more quickly in the future, because at this point, what's really going to save inflation is not going to be the Fed. What's going to harness inflation, what's going to stifle inflation is not going to be the Fed's policy. What's going to stifle inflation is going to be a pullback in consumer purchasing. That's what's going to cause it, based on fear of a recession, which is pretty much guaranteed. Here in a couple of weeks, we'll officially be in a recession. Does a recession mean that everything has to go to hell in a handbasket? No, that's not what it means at all. It just means that we've got negative growth. So we're contracting, which usually means that the contraction rolls downhill, right? If the whole thing is contracting, that means some people, companies will have to contract. People will have to contract their budgets. It rolls downhill. Less spending will take place until we find where that okay place is, and then we'll move again from there higher. But we got to find that place. I don't think there's a big move to the downside. Everyone is so fear-mongering on YouTube right now. My God, people, just take it easy.
Hated it.
Way too early to say the sky is going to fall. If the sky does fall, you'll just be lucky that you called. You have no reason to believe that. There's nothing here yet that we've seen that says crash is coming. It's going to be ugly. It's going to be really bad. It's going to be so bad. We don't have anything like that yet. Remember, you can't really have a crash inside of inflation. So we need massive deflation to take place. You need inflation to kind of go away, and then you can crash. But if inflation goes away, will we crash? Probably not. Think about that. Inflation is what's causing interest rates to go up. Inflation is what's causing a lot of prices to go up. If that goes away, do we still crash? Because you have to deflate first. That will happen before a crash. This isn't sneaking up on anyone. Everyone's known about this for a long time. There's nobody, at least let's say there's very few people who are like, inflation? What are you talking about today? Everybody knows. Everybody's seen it. This has been going on for some time. This is not sneaking up on anyone. People will pull back their purchases. That is a deflationary activity. That deflationary activity will cause inflation to subside enough for the numbers to look good, and maybe good enough for the Fed to say, you know what? Fire it up. Yeah.
No!
It would be a mistake for them to do that. But you know they want to. They're addicted to the money printer go brr. They love it. They feel like they're really doing something. Let's move the economy forward. Just been blowing up bubble after bubble after bubble. But you can tell they want to. They didn't want to do this. They desperately didn't want to tighten. Gosh, they didn't. They told us inflation was transitory. They know damn better. But they want their foot on the gas so bad. Touching the brake is just like a race car driver. They hate the brake. They have to use it, right? Have to use it. They hate it. Rather be on the right side. So anyway, this is where we're at. This is what's going on. I'll keep you posted. We're going to have a multitude of things happen, I think, this week, which are going to be important to make note of. Most importantly, what happens with interest rates. I think right now, that's the number one thing. Going to be doing several interview segments this week. Going to be on Dan Parker's YouTube channel on Wednesday, recording another national TV spot on Wednesday, and then recording in-studio content on Friday at our new studio, which is so sick. So sick. Production level was going way higher. Bunch of stuff that's going to be really fun about that. So anyway, that's what's going on this week. I'll be in touch. If you need me, give me a call, give me a text, shoot me an email. I will be here for you. Let's get through this together. Let's stay reasonable. Don't let the fear mongering get to you. If you catch yourself thinking the sky is going to fall or that you should sell your baseball card collection, take a deep breath, step back, look at everything and say, what is really going on? What is really happening in my life? What is really changing? Be very brutally honest with yourself. And you'll see maybe things aren't as bad as I think they are. Maybe they could get worse. The best thing you can do is do the best with what you have right now, and don't expect things to get terrible, because it doesn't necessarily mean, even if things are going to get worse. I saw Jim Cramer. Oh, did I not put that up here? Jim Cramer said, let's see if I can find it. He said, now's not the time to buy stocks, something like that. Oh man, I meant to pull that up. And I always use the story from Jim Cramer, and this is the last thing I'll give you today. He was right. In the crash of 2008, he was actually right. He came out on TV. It was almost like a press conference kind of situation. He came out on TV and he said, sell, get out. He said that when the Dow was at 10,000. And within a month or two, the Dow was at 6,600, where it bottomed. And so he looked right. And he was right, 34% right. But after we hit that bottom, I remember Obama came out and he said, hey, if stocks are down this far, that probably sounds like a good time to buy. Smartest thing he could have ever said. Probably a good time to buy. I remember him saying that. I was like, gosh, that was such a smart thing to say. And stocks just ratcheted from 6,600 to 36,000. Okay, over the course of 5 years, or whatever it was, 10 years. It's 500% in 10 years. So he was right. But if you just heard that and you didn't know when to get back in, there's a certain point where you're kicking yourself. You're like, wow, I was right, but I was right for a few months and then I'm wrong. So getting out of things and getting back in, you have to be right twice. You have to get out at the right time. You have to get in at the right time. Most of the time, it will be wiser to just hang on to whatever it is you have, but you need to take an inventory of that yourself right here, right now, because people who are selling their investment real estate because they think they'll be able to buy something better in a year or two, they might be right. But I know for sure in 20 years, your real estate that you bought, even if you just bought it yesterday, it's going to do very, very well. So stick with what you know, and you don't have to do anything. You don't have to be a hero here. Just be smart, keep your head down, do the right things. All right, guys, that's it for me. Give me a call, shoot me a text if you want to buy a refi, shoot me an email. Good to be back. I'll see you again soon. Have a good one.